Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Illinois Tool Works was founded in Chicago in 1912. Over more than a century, it evolved from a small toolmaker into one of the world's most admired, diversified industrial manufacturers, with operations spanning 7 distinct business segments.
The business today spans automotive OEM components, food equipment, test and measurement electronics, welding products, polymers and fluids, construction products, and specialty products, over 1,000 distinct business units in total.
What makes ITW truly distinctive isn't any one product. It's the management system. The company uses an 80-20 business simplification approach that focuses resources on the top 20% of customers, generating 80% of revenues.
From a financial standpoint, the 80-20 model has produced operating margins around 27%, exceptional for a diversified industrial company. Most peers operate at 15 to 20%, making ITW a genuine outlier on profitability.
Return on invested capital is another area where ITW stands apart.
ITW embeds engineers directly with customers to develop proprietary components that get specified into product designs. Once your component is inside a customer's assembly line or food production process, switching becomes technically and operationally difficult.
The dividend history is remarkable. 60 consecutive years of annual dividend increases qualify ITW as a dividend king, one of only a small number of companies to have maintained that streak.
Free cash flow margins run around 22%, and the company consistently returns capital through dividends and buybacks simultaneously. The low capital intensity of the simplified business model is what makes this possible sustainably.
In 2013, ITW completed a major portfolio restructuring, divesting the majority of its non-core segments to sharpen focus. The company shrank its revenue but dramatically improved its margins, quality of earnings, and competitive positioning.
Competitors in the industrial space include Emerson Electric, Parker Hannifin, and Honeywell. ITW differentiates from each through the 80-20 model's margin discipline and the breadth of its customer-embedded application engineering capabilities.
Christopher O'Hurley became CEO in 2023, succeeding E. Scott Santee, who spent a decade executing the simplification strategy. O'Hurley is also a long-tenure ITW insider, suggesting the management culture of operational discipline is deeply embedded.
Earnings per share have grown at approximately 10% annually over 5 years, driven by the combination of modest organic revenue growth, margin expansion, and steady share count reduction through repurchases.
ITW manufactures in more than 55 countries, giving it the geographic reach to serve global automotive, food processing, and industrial customers wherever they operate their own manufacturing facilities.
The decentralized structure means each of the 1,000-plus business units operates with significant autonomy, but within a shared framework of financial metrics, customer focus, and the 80-20 discipline that defines the ITW system.
That's the company chapter for Illinois Tool Works. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Illinois Tool Works reported Q1 2026 adjusted EPS of $2.66, beating the $2.57 estimate by 3.5%. Revenue of $4.02 billion grew 4.6% year over year. The stock fell 1% post-earnings. With 6 buy ratings, 12 holds, and 9 sells, ITW carries one of the most bearish analyst configurations of any large-cap industrial in the S&P 500.
Illinois Tool Works is a diversified industrial manufacturer operating in 7 segments: automotive OEM, food equipment, test and measurement, welding, polymers and fluids, construction products, and specialty products. Founded in 1912, ITW has spent the last 15 years systematically simplifying its business, a strategy called 80-20 that focuses resources on the most profitable 20% of customers and products while pruning lower margin lines.
At $74.4 billion in market cap, ITW trades at 23 times forward earnings, a premium to many industrials reflecting its best-in-class operating margins. The company has grown its dividend for 62 consecutive years, making it a dividend king. CEO Christopher O'Hurley oversees a company that generates 25% plus operating margins, a level most industrials only dream about, through relentless portfolio simplification and enterprise initiatives.
Q1 2026 EPS of 266 beat the 257 estimate by 3.5%. There is no gap between GAAP and adjusted EPS this quarter, a clean earnings print with no one-time items. Revenue of $4.02 billion grew 4.6% year-over-year, matching the mid-single-digit organic growth target management set at the start of the year.
Automotive OEM is the largest segment by revenue, serving global automakers with welding equipment, fluid management systems, and assembly components. This segment is navigating the EV transition. Many of ITW's welding and fastening products are agnostic to powertrain type, which limits disruption risk. Food equipment, serving commercial kitchens and restaurants, grew modestly as restaurant traffic recovers post-pandemic. Welding delivered solid volume growth, driven by energy and fabrication end markets.
Gross margin of 43.8% expanded modestly year-over-year, driven by enterprise initiatives. ITW's internal continuous improvement program focused on simplification and productivity. Operating margin of 25.4% is among the highest in the diversified industrial sector. Each percentage point of margin at this scale represents approximately $40 million in annualized operating income.
Net margin of 19.1% reflects the strength of ITW's portfolio quality. After the 80-20 simplification removed lower margin segments, the remaining businesses command premium pricing and operate at above-average efficiency. Operating cash flow conversion remains above 100%, meaning ITW converts more than every dollar of net income into cash, a hallmark of the 80-20 business model.
Free cash flow on a trailing 12-month basis was $2.21 billion. Cash on hand was $827 million. Net debt of $8.32 billion reflects decades of buybacks and dividends funded partly through leverage. Return on invested capital remains above 30%. ITW allocates capital exceptionally well within its chosen businesses.
Full year 2026 EPS consensus is $11.23 on revenue of $16.6 billion. Management maintained its full year guidance range without revision. The guidance confirmation at mid-single-digit organic growth reflects confidence in industrial end market stability, but provides no upside catalyst from guidance beats, a pattern that frustrates bulls in high-multiple industrial stocks.
The analyst configuration at ITW is the most bearish in this episode batch: 6 buy, 12 hold, and 9 sell ratings. More analysts recommend selling ITW than buying it, a rare situation for an S&P 500 industrial with 62 years of consecutive dividend growth. The average price target of $273.50 implies approximately 6% upside, modest for a stock at this multiple.
The bull case from the minority of buy-rated analysts centers on margin durability. ITW's 25% operating margin is not an accident. It is the structural result of 15 years of 80-20 simplification that competitors cannot easily replicate. Analysts at Goldman Sachs argue the margin floor justifies the premium multiple, and that any revenue acceleration from an industrial cycle upturn falls almost entirely to the bottom line.
The bear case is the majority view. At 23 times forward earnings, ITW is priced for perfection in a slow-growth industrial business. 4.6% organic revenue growth does not justify a 23 times multiple when peers with comparable margins trade at 16 to 18 times. The premium assumes continued margin expansion, but the 80-20 journey is largely complete, limiting further simplification gains.
Peer valuation context amplifies the bear argument. Emerson Electric trades at approximately 18 times forward earnings with comparable segment diversity. Parker Hannifin trades at approximately 19 times with higher cyclical exposure. ITW's 5 to 7 multiple point premium to these peers reflects dividend king status and margin consistency, but bears argue that premium is too wide given the growth profile.
The consensus takeaway: ITW is an elite business at an expensive multiple. The dividend is sacred. 62 consecutive years of growth is a rare institutional credentialing signal. But organic growth of 4 to 5% at 23 times earnings leaves limited room for upside surprise. Watch the automotive OEM segment. Any EV disruption to ITW's assembly component business is the key downside risk not visible in trailing margins.
The bull case rests on margin durability and dividend compounding. ITW's 25% operating margins have been remarkably stable across economic cycles. The 80-20 simplification created a portfolio that behaves more like a consumer staples company than a cyclical industrial. If margins hold through the next economic downturn, the multiple compression bears expect simply may not materialize.
62 consecutive years of dividend growth creates a floor of institutional buying. Dividend King inclusion screens drive passive buying at any price weakness. Pension funds and income mandates with explicit dividend growth requirements view ITW as a core industrial holding. The structural buyer base from dividend growth ETFs has grown significantly as that category has expanded, providing price support that pure valuation analysis understates.
The bear case is about value. 9 sell ratings outnumber 6 buys. The sell-side consensus is that ITW is expensive relative to its growth profile. At 23 times forward earnings, the multiple prices in margin expansion that may be largely complete. The next earnings leg must come from revenue, and 4 to 5% organic growth does not justify that multiple.
Net debt of $8.3 billion from aggressive buybacks creates risk asymmetry. In a severe industrial downturn, auto production cuts, restaurant closures, construction slowdown, revenue could decline 10 to 15% with limited fixed cost flexibility. Free cash flow would compress faster than revenue, potentially pressuring the dividend for the first time in 62 years.
Automotive OEM exposure is a structural uncertainty. As EV production rises, assembly processes change. Electric motors require different fastening systems than combustion engines. ITW argues product neutrality, but the transition creates years of uncertainty around content per vehicle.
The stock fell 1% on a solid EPS beat. The market yawned. Limited upside reaction at 23 times earnings is a classic price for perfection signal. Any negative surprise produces outsized downside with little valuation cushion.
Emerson Electric is the closest business model peer. Emerson has been executing its own simplification strategy, divesting climate technologies and focusing on automation and process control. Emerson trades at approximately 18 times forward earnings, representing a 5 multiple point discount to ITW. Bulls argue ITW deserves the premium for superior margins. Bears argue the gap is too wide.
Parker Hannifin is the scale industrial peer. Parker operates motion and control technologies with significant aerospace and industrial automation exposure. At approximately 19 times forward earnings, Parker trades at a comparable discount to ITW. Parker has been active on acquisitions, Meggitt integration is ongoing, adding earnings complexity that ITW's simplification model avoids entirely.
Eaton Corporation competes in electrical systems and automation. Eaton has benefited from data center and grid infrastructure build-out, a growth tailwind ITW lacks. Eaton trades near 22 times forward earnings, close to parity with ITW despite higher revenue growth. If Eaton's data center exposure continues to outperform, the valuation gap narrows at ITW's expense.
Across diversified industrial peers, ITW's margin leadership is undisputed. No peer consistently delivers 25% plus operating margins at this scale. The question is whether that leadership justifies a 5 to 7 multiple point premium to peers with comparable or higher revenue growth. The sell-side majority says no. That is the core of the bear thesis.
Pre-earnings options positioning was neutral to cautious. The options market implied a 2 to 3% move around Q1 earnings, small for an industrial of ITW's size and consistent with its low volatility, slow growth earnings profile. The actual 1% decline was within the expected range. No unusual put or call buildup was detected ahead of the print.
Post-earnings options activity was quiet. Institutional holders of ITW typically use the stock as a covered call destination within dividend growth strategies, selling monthly or quarterly calls against long positions to generate income above and beyond the 2.45% dividend yield. The lack of aggressive directional positioning post-earnings reflects the lack of a strong catalyst in either direction.
CEO Christopher O'Herlihy participates in standard equity compensation programs with no significant open market purchases disclosed. The board's commitment to the dividend, maintaining 62 consecutive years of annual increases, is the clearest signal of management's view of earnings durability. No insider has signaled a belief that the stock is meaningfully cheap at current levels through open market buying activity.
Institutional ownership is heavily concentrated in dividend growth and quality factor ETFs. Vanguard, BlackRock, and State Street represent the three largest institutional holders through passive funds. The Dividend King designation drives inclusion in specialized income ETFs that provide inelastic buying pressure on any dip below key technical levels, a dynamic that has historically supported ITW's floor valuation even when the sell-side consensus turns negative.
ITW delivered 3.5% EPS beat, 25% plus operating margin, 4.6% revenue growth, and 62 consecutive years of dividend growth, the 80-20 simplification model at its best.
Risks are real. 9 sells outnumber 6 buys. 4 to 5% organic growth is unimpressive at 23 times earnings, and net debt of $8 billion limits flexibility. At $245 with a 2.45% yield, ITW is a quality industrial priced like one. Watch automotive OEM volumes and guidance revisions. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.